A few years ago, my friends and I were hustling on a startup project. And like every young entrepreneur or founder, cash was tight. But we had one big advantage. One of our partners was a seasoned Forex trader. He trained other traders, managed real money for investors, and seemed to command the markets. So when one of the other partners suggested combining our limited funds and handing them to him to trade, everyone thought it was a no-brainer. To say we were stunned when he said no would be an understatement. My mind raced. And in my head, I had questions like, was he not as skilled as we believed? Or was he genuinely worried about us and our money? Was it fear, wisdom, or something deeper? And now, I'm throwing these same questions to you. What do you think? You can drop your thoughts in the comments right now, or hold it for later in the video when I come back to this story. A few months after launching this channel, a subscriber reached out to me. He was desperate. He had lost a lot of money in the market. And this wasn't just any money for that matter. It was his father's pension. Money meant to provide for the family. And he'd just burned it all on bad trades. He wanted a quick fix and asked if I could help him recover it. Just like my trader partner did back then, I had to say no. I told him honestly that I can't undo that kind of loss. I didn't sugarcoat it. I simply said, I can't help you with that. Why, you might wonder, was it because I don't know how to trade? Or because I genuinely believe helping someone chase losses is wrong? Was it protecting him or protecting myself? Whatever your take, what you'll see in this video is far more important. We'll explore the psychology of risk, how to stay calm in the face of fear, keep greed under control, and how to steer clear of these emotional traps that destroy portfolios and peace of mind. If you are ready, it's time to upgrade your mindset and your trading game. The psychology of risk, the behavioral finance perspective. Meet Victor Ricciardi, a true veteran in behavioral finance, a field that asks, why do smart people still make dumb money decisions? Ricciardi isn't just another theorist. He is a best-selling author, journal editor, and researcher who has spent years uncovering how our minds hijack our money moves. His recent paper, The Psychology of Risk, the Behavioral Finance Perspective, digs into how our brains twist risk perception in deceptive ways. Most people think the smartest money choices come from hard data, but Ricciardi says, think again. Here is what he discovered from his research. 1. It's not the numbers, it's how they feel. If someone says, there's a 70% chance Bitcoin hits $1 million, your brain lights up, and it's feeling the jackpot vibes. But flip it and say, there's a 30% chance it won't happen. Now it suddenly feels risky. The fact is, it's the same numbers, same odds, but a completely different feeling. That's your brain playing tricks on you, reacting to how something is said, not what is actually being said. 2. Your past matters more than you know. If you've been burned by the market before, your brain remembers, and it doesn't let you forget. Even when the setup looks perfect and the odds are clearly in your favor, something inside you whispers, don't do it. It's like your brain has a scoreboard of past pain, and every trade starts to feel like a rematch with your worst losses. So instead of playing to win, you start playing not to lose. And that's how fear steals your edge, quietly, but consistently. 3. Emotions rule when the pressure is on. If you've ever made a trade when you were super hyped or low-key freaking out, that's the danger zone. Because when emotions run high, logic checks out. You're not following your plan, you're reacting, chasing wins and dodging fear. And just like that, you go from calculated trader to emotional gambler. That's how solid setups turn into messy mistakes. Fast. 4. Overconfidence is a silent killer. You know that feeling when you think nothing can stop you. So you double your risk, thinking you've got it all figured out. Or maybe you hate taking losses so much, you hold on to bad trades way too long, hoping they'll magically turn around. One is fueled by overconfidence, the other by fear. and both can wreck your account faster than you think. Ricciardi reveals that this emotional roller coaster is the root of all bad trading decisions. And when thousands of traders ride the same emotional wave, guess what happens? That's how bubbles form and markets crash. It's not luck or timing. It's mass psychology in action. Your brain doesn't measure risk, it messes with it, bends it, lies about it. And if you don't catch it early, you could be making money moves you'll regret. The true meaning of fear and greed. The Enron case study. It's the year 2000, and Enron is the rock star of corporate America. Its stock is soaring at $90 a share, its executives are smiling on magazine covers, and Wall Street is practically throwing money at them. The company started out as a humble natural gas company, but had just reinvented itself as a flashy energy trading titan. But behind the glitz, things were not what they seem. Jeff Skilling, the hotshot CEO, had a wild idea. Why bother with real profits when you can just make them up? Through a trick called mark-to-market accounting, Enron started counting future, what-if, earnings as cash in hand today. If they signed a 10-year energy deal, they book all 10 years of projected profits right away. And the numbers look dazzling on a spreadsheet. Meanwhile, CFO Andrew Fastow was playing a shadier game. He set up fake companies with cool names like Raptor and Jetty to sweep billions in debt under the rug. These weren't real businesses, just financial sleight of hand to keep Enron looking strong while it was secretly drowning in red ink. By August 2001, Sharon Watkins, a vice president, dropped a bombshell memo. "We're heading for a disaster of accounting scandals," she wrote, practically begging the CEO to act. But the top dogs weren't interested in bad news. They were raking in millions in bonuses from their make-believe success. So why ruin a good party? By the time fall rolled around, the truth was starting to slip through the cracks. Reporters began asking the right questions, and suddenly Enron's golden image started crumbling fast. In September, the stock was around $30. By October, it dropped to $10. In November, it was worth mere cents. Come December, Enron had to file for bankruptcy, the biggest corporate collapse in U.S. history at that point. While the top executives quietly sold off their shares before the crash, regular workers were left holding the bag. Employees lost their entire retirement savings, most of it tied up in Enron stock. 20,000 people lost their jobs overnight. Even Enron's accounting firm head, Arthur Andersen, who was caught red-handed destroying documents to cover up the fraud, went down too. Jeff Skilling, former CEO of Enron, was sentenced to 24 years in prison, later reduced to 14. Andrew Fastow, Enron's CFO, who blew the whistle, served 6 years behind bars. Ken Lay, the company's founder and chairman, sadly died before he could be sentenced. If you're wondering what all this has to do with fear and greed, Enron wasn't just some accounting trick. It was about people. Real people making decisions driven by greed, wanting more and fast. Real people making decisions driven by fear. Fear of looking weak, fear of losing power, fear of telling the truth when it mattered most, like I told the subscriber who needed help. And when these two emotions take control, everything starts to crack. Unfortunately, we've seen the same playbook again and again. During the 2008 financial crisis, during crypto crashes, and in countless corporate scandals since. Different faces, same trap. When money becomes the goal and fear keeps people silent, the system breaks. Every single time. So how do you manage greed and fear? The answer to the question. To answer the question of why our trader friend likely refused to trade the group's funds, and why I couldn't help that subscriber recover his losses, it comes down to this. Managing fear and greed isn't just good trading advice. It's the foundation of long-term survival in the markets. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." It's brilliant not because it sounds clever, but because it reveals a deeper truth. Smart traders don't follow emotions. They step back from them. Our trader friend probably saw what most beginners don't. The moment you start trading with money you can't afford to lose, especially money pooled from friends or meant for someone's future, you're not trading anymore. You're gambling with emotional landmines. Fear of losing, pressure to deliver, and a greed that says, just one big win will fix it, start to take over. When the subscriber approached me, I saw the same thing. He wasn't looking for a trading plan or a strategy. He was driven by fear and desperation. And in that state, trading is dangerous. I didn't say no because I didn't want to help. I said no because helping him chase losses would only deepen the damage and make him feel there is a quick fix to trading problems. If I had said yes, it's very possible I would lose more money. Because deep down, it wouldn't just be about the trades. It would be about my ego. I wouldn't want to disappoint and fail, and that fear will mess with my decision-making. I will definitely lose trades, but in wanting to win so badly, I'd start forcing trades. Fear and greed don't show up with a warning. They slip in quietly, take over your thoughts, and start running the show before you even realize what's happening. According to Victor Ricciardi's research, these emotions don't come with labels. You won't get a memo saying, "Hey, you're acting out of fear right now." But the moment they take control, your trading rules is gone. And that's the trap. Thinking you're making smart, strategic moves when you're actually just reacting to emotions. This is why awareness is everything. The moment you realize fear and greed sneak in without notice, you can start to manage them. The real skill isn't in avoiding them altogether. It's in recognizing when they're in control and stepping back before they take the wheel. If you're still battling with emotional trades, disciplined slip-ups, or the urge to get back at the market after a loss, you're not alone. And you're definitely not broken. That's why I recommend you join our Telegram channel. We share daily tips on psychology and sometimes trading signals. The link to the channel is in the description. If you're ready to build real mental toughness, trade with more clarity, and stop letting your emotions hijack your setups, this recommended video is your playbook. In the video, we break down the real psychology behind staying focused, calm, and consistent no matter what the market throws at you. Click to watch and upgrade your trading mindset for good. If you found this video helpful, please don't forget to drop a like, share it with someone who needs it, and leave a comment below. I read and reply everyone. Until next time, trade smart, stay sharp, and may the trend be with you.